going to talk about a little different way of funding that I think could be of interest to people. So I wanted to talk about royalty financing because it's an alternative to what you normally see, which is equity financing. And we've done a number of these. We've done a dozen of these, and they're very effective because they don't dilute the equity. And so they're very attractive to companies that are looking for the opportunity to invest in and raise capital. The equity, as you all know, is dilutive, and it's at a valuation which is at today's valuation, which might be low for a company that's very early stage. And so, if there's a way of avoiding the dilution of equity, that's always desirable. It's not always possible, but it is desirable, and there are a few ways to do it. And I'm going to go through some examples in a minute. Another very common vehicle is a safe note, in which the dilution is postponed until there's a Series A round or a later round in which it becomes an equity round. So it really is a debt security that postpones it. It's not a great deal for the investors, but it's very commonly used, particularly for early stage companies that just don't know what the valuation of their company should be today. And that's a good question, and it's something that a lot of factors go into setting a valuation. Another vehicle is subordinated debt, and that's often used by investors who also don't know what the security should be, what the company should be valued at. It's also used for later stage companies. And then you have crowdfunding, which is becoming very popular today. It's getting a lot of attention. There are some regulatory issues that have to be considered. And there is the issue of dilution, which people do need to concern themselves about because it is dilutive. And finally, revenue financing, which is one I'm going to focus on, also called royalty financing. It's highly flexible and it's non-dilutive. And typically it includes debt plus a percentage of revenue as one instrument. And so let's say it's a $2 million note. It would be the debt portion would be payable on some terms. It could be amortizing, or it could be a balloon note that's due at the end of 5 years. And the royalty is typically small, only about 0.5% to 1%, and sometimes it might be as high as 2 or 3%. But because the principal is being repaid in some manner, that keeps the royalty down. A pure royalty is another way of going about it, in which case all of the proceeds and all of the costs of the royalty is repaid through the royalty security. And that is typically a higher royalty rate. And again, this is not a royalty on intellectual property. This is a royalty as a repayment mechanism to the investor that provides you capital. And then there are other variations that we've seen, which also are ways to look at this. One example is a solar company that we met with and we ultimately funded. They previously had been funded through research grants, so they had never given up any equity except to some of the employees through their plans, their stock option plans. And so they approached us, and we liked the company very much, and so we structured a royalty deal for them. They had a very good pipeline of business. They were relatively small. They were doing about $1 million, $1.5 million at the time, but they had a sales pipeline, that is prospects, of $9 million. So that really said that they had a good future ahead of them. And since we did that financing, we put I think it was $2 million into the company. The company has done very well. Another company we funded was a little bit more mature company. They had sales over 5 million. They were profitable. And so that was a little bit different structure. That company was sold 4 years later, and substantial profit to the owners because, again, they did not have to give up equity. Early stage companies are the most challenging. And so we developed a variant to conserve cash. And in this particular example, the company had invested $12 million into their technology, which is really good. But their sales were very nascent. They were only 250,000 in the last year, and they had substantial losses. And they had expected to do more than $1 million last year, but COVID-19 really hit them hard. And so we structured a convertible debt security that had a 5% royalty. But at the end, at the time they did their next round of financing, which we felt with our capital they can do, uh, uh, that security, that debt security, will convert to equity, and that made them very happy because they ultimately wanted to have us as an equity investor. Uh, and so that's how that works, and it also helps the company postpone the valuation and the dilution until a later round. So they got what they want, and we got what we wanted, and so that's a win-win, which you can do with a royalty type security. Um, we've done 12 of these types of financings in the past. Many companies repay the debt early, and when they do repay it early, that because through another financing round, that ends the royalty. So some companies see their sales about to take off, and they like to prepay the royalty, prepay the debt, so that the security can be relieved. Royalty financing is less costly. The cost decreases if the sales decrease, so that if sales decline, your obligation declines, and then as sales grow, then the repayment schedule resumes. It can be repaid at any time, and then the royalty ends. And the amount paid to the lender that is in excess of the original loan is fully tax deductible. So the exit value is just as high, because when the royalty ends, or when the sale of a company occurs, the royalty ends. So that gives people the opportunity to, again, not experience the dilution, but have the benefit of a security that is not taxing to their personal estate. Small companies, small public companies that are trading at a low price, that need to raise money, can use this security too, because often the valuation of a small public company is not very high. They may have gone public at $5 a share, but it's only trading at maybe $1.50 a share. And this is a way that the owners can ultimately realize what value they believe the company is really worth. It can also be used in management buyouts and ESOPs, employee stock ownership plans, and family-owned companies where they would like to keep control and ownership of the company closely. I'm a big fan of companies that the owners want to stay and keep the business long term. The notion that you have to sell the company in 3 to 5 years to realize a gain for your investors, there are other ways of realizing that gain through a recapitalization and other means. But I'm a strong believer that a company should stay in the hands of those who started it, created it, so that they can stay with it and long term realize what they would like. That's it. Thank you very much. If any of you would like a copy of the slide deck, my contact information is there.